This is the Farm Doc Daily Webinar. I'm University of Illinois Extension farm broadcaster Todd Gleason. Thank you for joining us today. We'll go through some of the 2024 Illinois Farm Economic Summits. Today, macro and farm financial updates with Brad Zwilling and Gerald Mashange. Thank you, both of you, for being with us. Good morning to you, Gerald. Thank you for taking us through the first part of this presentation.
Thank you, Todd. Hello, everyone. Today's webinar is the Macro and Farm Financial Update. I'll begin the presentation by discussing the state of the U.S. economy by focusing on GDP growth, inflation, and interest rates. I'll then hand over the presentation to Brad, who will provide an update on the financial trends of Illinois. So starting off with the U.S. economy, U.S. real GDP increased at an annual rate of 4.9% in the third quarter of 2023. According to the Bureau of Economic Analysis. The increase in real GDP was driven by increases in consumer spending, private inventory investment, U.S. exports, state and local government spending, federal government spending, and residential and non-residential fixed investment. Fourth quarter GDP estimates were actually announced earlier this morning, and estimates indicate the GDP increased at an annual rate of 3.3% in the fourth quarter of 2023. Again, GDP growth was mainly being driven by strong consumer spending. This is a notable deceleration from the 4.9% in the third quarter. This announcement surprised many since the expectation was for GDP growth to be 2% in the fourth quarter. The main takeaway here is that the economy appears to still be resilient. However, we're beginning to see a slowdown in the U.S. economy. As you can see, the post-pandemic reopening of the economy and stimulus payments had a notable impact on personal consumption spending. Although personal consumption spending is still strong, it is trending downwards. This is being driven by our current high interest rate environment, declining savings, higher prices, and the resumption of student loan payments. It should be noted, however, that consumer spending accounts for about 2/3 of U.S. economic activity. So this portion of U.S. GDP is very significant. Personal consumption expenditures on food is also trending downwards. In fact, this has been the trend since January 2022. Overall, consumer spending will likely continue to slow down in the first quarter of 2024. Now let's take a look at inflation. The Fed has hiked interest rates 11 times from nearly zero since March 2022. This is the fastest rate hike in 40 years. And these rate hikes were necessary to fight inflation since higher interest rates cause a slowdown in spending. The current federal funds rate target is 5.25% to 5.5%. And this is the highest target rate in 22 years. It has taken a while for us to see falling inflation and consumer spending, since interest rate hikes take time to work their way through the economy. We are likely to see a continued high interest rate environment in 2024. However, rate cuts are expected this year as inflation and the economy cools down. The Federal Reserve Bank's preferred measure of inflation is the Personal Consumption Expenditure Price Index, and this measure of inflation has been gradually falling and approaching the Fed's inflation target rate of 2%. In November, inflation came in at 2.6%. It was 2.9% in the previous month. So this trend is positive. Now, the inflation estimate for December will be released tomorrow morning, but it too is expected to continue approaching the 2% inflation target. Now, looking into the future, the bond market expects the Federal Reserve Bank to be near its inflation target of 2% in the next 5 years, as shown by the 5-year break-even inflation rate. Now let's dial in and take a look at agricultural credit conditions in Illinois, according to lenders. So Illinois is serviced by both the Federal Reserve Bank of Chicago and the Federal Reserve Bank of St. Louis. So we have to consider the interest rates reported in both districts. Average fixed interest rates on operating loans have almost doubled over the past 2 years in both districts. The difference between the two districts has tightened in that period. Average interest rates on operating loans in the third quarter of 2023 was 8.8% across the southern Illinois counties serviced by the Federal Reserve Bank of St. Louis, while northern Illinois counties serviced by the Federal Reserve Bank of Chicago was slightly lower at 8.5%. Similarly, average fixed interest rates on farm real estate loans have almost doubled compared to what they were in the third quarter of 2021. The difference in interest rates between the two districts in the third quarter of 2023 is much larger for farm real estate loans compared to operating loans. We can also see that the difference between the two districts has widened since the second quarter of 2022. Where here we see that southern counties in Illinois had an average fixed interest rates on farm real estate loans of 8.4%, while northern counties had a rate of 7.7%. So what is the impact of higher interest rates on farm incomes and loan repayment? Well, farm incomes and credit conditions are softening in the farm economy. According to bankers responding to the Federal Reserve District surveys of agricultural credit conditions, farm loan repayment rates were largely unchanged compared to a year ago. This coincided with the modest decline in farm incomes in the Kansas City, Minneapolis, and St. Louis Federal Reserve districts. Overall, agricultural loan performance remained strong in the third quarter of 2023. Delinquency rates on real estate and non-real estate farm loans continue to trend downwards from their peaks in 2020 at both agricultural and commercial banks. The main concerns on the minds of farm lenders in 2024 are higher input costs, interest rates, and drought. Now, in terms of the long-term outlook on inflation, Fed officials are happy with the progress they have made in tackling inflation, but we aren't out of the woods just yet. They have indicated that they expect cuts over the next 24 months, and we can examine the Fed dot plot to get an understanding of the collective view of the Federal Open Market Committee, or FOMC. This is the committee that sets the federal funds rate, and their median projections are a federal funds rate of 4.6 in 2024, indicating rate cuts that are expected in this year, 3.6% in 2025%, and 2.9% in 2026. If inflation readings continue to move towards 2% on a sustained basis, we may see the first rate cut as early as March. However, a lot can happen between now and then, as we have seen with the recent shipping disruptions in the Red Sea and the potential situation of a broader conflict in the Middle East. The main takeaway here is that the Fed officials aren't completely convinced that they have defeated inflation. I'm now going to hand it over to Brad, who's going to discuss the financial trends of Illinois farms.
Thanks, Gerald, for that overview and kind of some projections for what the economy is going to look like in the upcoming years. What we're going to look at here is things that we've seen on Illinois farms, primarily grain farms in Illinois that are enrolled in Illinois Farm Business Farm Management. We're first going to take a look at the slide. It's operators' share of labor and management income from 1972 through 2022 and then projected for 23. So what this graph is telling you is taking basically the accrual net farm income and taking out an interest charge on your equity and then giving you what's left for your management and labor of that farming operation. And this graph is adjusted for inflation, so you can see some interesting trends during this time. If you look at the kind of off-white section from 1980 to 2006, we see a period is kind of relatively stable where we had incomes a little less than zero all the way up to 100,000. So we had variability in that time, but not big variability like we saw in the next period, which is blue, the 2007 to 2012 time, where we had the ethanol mandate, and also we had the big year of the drought in 2012. We had some very we had the highest years in there, and we had a little bit lower year with that 2019 year or 2009 year. And when you look at that, the highest year was 299,526 when adjusted for inflation. And then you come in the period after 2013, we had the drought, and we had some lower incomes, and you can see in 2015 we had that lowest year ever with a negative $81,661. And it gradually worked itself up. But in that period of time from 2015 to 2019, that was the second lowest year of average income for that period of time. And then the first one was from 1980 to 1984. And the third one was from 1985 to 1989. So some very low incomes when we look at adjusted for inflation and some management and looking at labor and management income. And then you go to 2021 and 2022 were the highest years ever of this operator's labor and management income. And we're trying to forecast a little bit, and this was done in March and April of 2023, of what we thought as far as Illinois FBFM staff, where we thought that income was going to be, what our crystal ball looked like. And we thought that may drop about 100,000. We had some recent chats. We do some weekly, bi-weekly chats with our staff, and I've been hearing some mixed numbers throughout the state. And the biggest thing, since this is on an accrual basis, is the impact of lower inventory, especially the prices, and that big change in inventory and the impact on what our accrual incomes are going to be. Most farmers work in the cash world, but we report this on accrual so we can get the true look of a crop year. So with that income, let's just take a quick look at a farm operating income ratio. Basically, this is taking the accrual net farm income and dividing by gross income, and you can see where that's been over time. We like to see that about 20% over time, and you can see we've hit that when you look at this range from 2013 to 2022 when you average that out. We had years there, those lower years were kind of lean in the 0 to 20%. And then the last 3 years, we've been over 20% and well over 20% in 21 and 22. So just to kind of a measure to look at, you'd like to see that at, like I said, about 20% over time. Let's take a little bit look into now the assets that are on these farms. So they're primarily grain farms, like I said, in Illinois. And you can see that the average has been about $4,900 per acre from 2013 to 2020. And in that time frame, we had about 1,000 of that was in current assets. About 1,200 to 1,300 of that was in intermediate assets, which would primarily have been machinery. And then we had land, which is the fixed assets primarily. So it's 2,500 to 2,600. So primarily those assets, this includes all assets, not just the farm. And then we saw the run up in 21 and 22, with the majority of that being in our current assets because of the inventory prices increasing, but also seeing that our machinery values, we all know what happened after COVID, where it was hard to find parts to do repairs, and the used equipment market really jumped up as well. So we're going to take a little bit more look into what these assets are in a second. But first, let's look at just another liquidity measure, which is working capital. And when we look at this, I just like to look at two of them and look at the differences between the two. So the orange line is the working capital to operating expenses, and then the bottom line is the working capital to gross returns. That's typically what you hear. And that's averaged about 40% over time. You can see that that's going to change as we move forward with these lower incomes projected in 23 and 24. And also with that working capital expenses, we've seen 60 to 80% on average. So that means basically you could do nothing. You have enough working capital to cover 60 to 80% of those operating expenses in a year. So that's a good amount of liquidity we have out there on the farms to help weather the storm that is probably coming, as we know, as we wrap up the 23 records and look into 24's planning. Current ratio is another measure of liquidity. And the piece I really want to draw home on this one is we look at things in quartiles, and we have an upper quartile and the average. So the average would be the 50%. So 50% and below have been in that 2 to 3 range, which is a very good range, wouldn't you say, Gerald?
Yeah, it is.
And the upper quartile, that'll be what the top 25% would be at. That has been about 4 difference, and that has grown to as almost 6 difference in 2022. So those incomes that we've had, very high incomes, those good groups that have very good financial information have really put that money away and saved it back for some things to do, even though there's not a lot of assets they could invest in at that time where they were, but they're still holding on to that cash because they knew something was coming down the road. So let's go back to look at some individual asset pieces. So we're going to look at machinery values on our per acre basis on our Illinois grain farms. And we can see here that our machinery value has doubled in 7 years. When we look at 2007, that was about $300 an acre. That was right at the beginning of the run up in the ethanol mandate and the run up in grain prices. We also had some tax law changes where the expense selection started to go up as well during that period. And we go up to 2014, that's where it doubled to over $600 an acre in 2014. We're seeing, we were dealing with that high incomes from 2012 that we're still trying to do some purchasing of equipment to use as a tax planning tool as well, not just an investment in the farming operation. Those values kind of slowed down from that 2015 to 2020 period. And then they've ramped back up and started increasing a lot because we saw a lot of capital purchase in 21 and 2022, because not only because we're needing some replace some assets that we bought a lot of assets in 2011, 2012, and 2013, but we're also, because those values are increasing as a lot as well. Also, in part of this is going to be what's going on with some tax law changes in there, with the increased 179 deduction and bonus depreciation being used as well. Another asset we're going to look at is land. So this is looking at the value of owned land on our farms. And this has been increasing as well, not just because of the value, but because we've been adding land. You go back to 2003 with the starts, and so on average, we had about 0.51 or $510,000 of farmland on value in 2003. That doubled by almost 2010 at $1 million. And then we doubled again by 2021. And then we've gone up $250,000 in 1 year from 2021 to 2022. And we saw that increase a little bit more as well for 2023. So the key takeaway on this is those land values are increasing, but also take away that with Illinois FBFM, we're very conservative in the value we're putting in there that our cooperators have us help them with. And it may not be the full value, the market value. We'll put in there what they pay for it, but it'll be a little bit less than maybe what you could sell it for today. So those values are probably even higher than that if you really wanted to dig into this, but it still gives us a good estimation of seeing what the trends have been when you look at the land values. So let's put all of these assets together, and we'll put machinery and farm buildings we haven't talked about. As you can see, it's a lot less piece of this whole grand scheme of farm assets, and then farmland. So these are the intermediate and long-term assets primarily that we'd see on the grain farms. And we started out about $750,000 in 2003, and that ramped up to about $2.5 million in 2017, and then it continued all the way up to we're at $3.25 million in 2022. So really saw an increase those last 2 years. Remember, we looked at that total assets chart before. A lot of that gain was going to be seen right here with that farmlands and machinery and farm buildings. The other piece that we don't have in here, and we can see that, is those current inventory values, and we'll have some slides that talk about that a little bit more as well. So we've talked a little bit about that, the asset side. Let's talk about the debt side. Go back to some things that Gerald talked about in the macro side. So one measure we used to use before we had a debt to asset ratio is farm interest to a percent of gross farm returns. Gross farm returns have been really high the last couple of years, so it's no wonder that we see a really low 2.3% on our percent of interest paid to gross farm returns. But you look back to this graph, you look back to 1983 at the highest year ever that we had in this time period at 14.6%, because we had very low gross during that period of time and very high interest rates during that time as well. And you see that we've been going all the way down till that 2012 period at 2.5, mostly because interest rates were low, been very, very low for a long period of time, but also our gross really ramped up during that time. Then we saw that interest as a percent of gross started to increase after 2012. Interest rates probably didn't change much, Gerald, during that period of time. It was all gross farm returns that were going down because we had lower prices. And since 2020, we've seen that go back down again. And I think that's going to be turning the other way. We've got lower gross from what I'm hearing in 2003, and then we're going to have our 2023, and then a lot higher interest rates as we move forward, especially on the operating notes that we've got out there. So if we look at total debt on those farms, we're looking at, I broke these out in two different ways. At the top, Jim did a great job on this slide. So we've got short-term and long-term. Those have been trending about the same during this period of from 2000 to 2022. So you can see that those stay about the same. Short-term would be primarily your operating notes, and long-term would be primarily your farmland. And you can see we've started at about 100,000 in 2000 and up to about 400,000 in 2022. And notice that difference in that long-term and the short-term, primarily because we have a lot of working capital, so we're not utilizing so much of that operating debt, but also farmland's been going up, so we have a little bit more farm debt that we'd have there as well. And intermediate just stayed steady, about 500,000. Now it's up over $100,000 intermediate debt that we have on those farms. Remember, intermediate debt's going to turn over in 3 to 5 years typically, so those are where those are at. And then if you put all that together, and you remember back to the slide that we had the farmland, the farm buildings, and the machinery on, you can see that from 2000 we were at 250,000 up to $1 million of debt. Remember on the other slide, we had 3.25 million. So we have 2.25 million of net worth in these farm assets that we have out there just on average when we look at these Illinois grain farms. Key points to take away from this farm debt discussion we've had is since 1990, farm debt has increased about 4% per year. Debt level in 2022 is the highest ever when we look at it in real terms. Debt to asset ratio, we're going to look at that a little bit more in depth here in a minute. But if you look at it, we were at 33% in 1991, has dropped all the way to 18% in 2022. And I think that'll probably stay about that level in 2023. debt per tillable acre is $760 an acre. And you see off the right-hand side, we can see that dirt, or I was told that's soil on the right-hand side in that graph. It was $258 in 1991. So almost triple, or more than tripled in that period of time we're looking at on this graph. And interest expense per acre has stayed about the same. It was $21 in 2022, and it was $20.72 in 1991. We all know that interest rates were a lot higher in 91, and then started to come down, and then now we're going to see those start going back up a little bit. But our acres have been increasing too, so there's lots of factors going into that. But just some interesting pieces to see that interest per acre really hasn't changed much in that whole period of time. So we talked about, this is kind of a repayment measure, and you can look and see where incomes, if you remember a chart, the income chart at the beginning, those ups and downs are the same periods of time in there. Basically, you have to have income to repay that debt. And this is the same kind of thing that we see here. Just wanted to let you realize that our repayment capacity is pretty much driven by our net farm incomes on our farms. Debt to asset ratio, I talked about that earlier. Basically, this tells you how much of your assets that your lender owns. And so if you look at this, and then we broke it up by age and over the last 3 years. So you look at somebody that's less than 30, you can look at about 40 to 50% over the last 3 years of their assets were owned by a lender. But if you go older, you can see that 50 to 59 and 60 plus, those aren't really affected much over the last 3 years. Those are pretty stable. Mostly on those, most of the debt's still going to be in farmland, not a lot of machinery, a little bit of current debt as well. But you can see there's a lot more variability with the income levels. And let's look at the slide for over a 10-year period, and you see a lot more of the variability we see in that 2013 through 2020 period. And you can see there's lots going on in this graph, but it's interesting to see, that less than 30 group got up to about the highest point ever in this 10-year period of time in 2019 or 2020, and then has been going, 2019 and then coming down. But those 50 to 59 and 60 really, we had the highest of highs and lowest and lows in this period of time, and they weren't really affected too much in that debt to asset ratio. They were still paying down that debt, and those assets were growing during that time as well. So it's interesting to note. So always think about when you're looking at debt to asset ratios and any financial ratio in that case, pay attention to who you are and what kind of age you're at as well, because that makes a big difference in these. Kind of wrapped up a little bit on those financial pieces. Let's take a look at family living and taxes. This is a little bit a different thing to think about. We have about 1,300 farm families that show every dollar in and out of the farm and family operation that they have. And first thing I want to draw your attention to is in 2013, we had almost $130,000 of family living and taxes. And this is the income taxes they would pay. Look at 2022, about $130,000, a little over for 2022. So over that 10-year period, we're at the same place. We dropped down during that other time. But what's the big difference between 2013 and 2022? Well, 2013 was the year after the drought. So we had high incomes. And remember, we're typically paying the tax a couple years after we have the incomes, right? So for instance, in 2012, you sold most of the grain in 2013, probably paid the tax in 2014. So the 2013 tax we're paying had some to do with some of that crop insurance probably proceeds we had. But that had a lot of tax in that period of time. We're looking at almost $40,000 to $50,000 of tax versus 2022, where you got about $30,000 to $35,000 of tax. So family living has kind of leveled off, have been about the same. The other thing to point out is of all this, the farm has to cover a good majority of it. The net non-farm income covered about 40,000 of that 130, or 40,000 of that. So 90,000 had to be covered by the farm in 2013. And then in 2022, we're looking at about 60,000 was going to be covered off the farm. So now only 70,000 was covered from the farm. So in a very high year, we're able to put a lot of that income back and put it into net worth. So that's a good piece. But it also tells a story. What's 2023 and 2024 going to look like? I think we're going to have some big tax liabilities that we're going to have out there. We can do some work on managing those, but just be aware that some tax pieces are coming. Gerald, you have anything you want to point out on that slide?
Oh, no.
Yeah, good. So we talked a lot about assets and incomes, and this is one that doesn't get talked about all the time, but this is an estimation of deferred tax by asset type. So we've taken our average financial grain farm from 2003 to 2022, kind of held our rates the same. We all know that there's been tax law changes in there and different things have happened, but we kind of held them the same just to see what's going on with assets. And you go back, and these are in thousands of dollars. So the average, and we do long-term, intermediate, and current, and this is not just farm, this is all assets that they would have. So we look back, we had about $200,000 of deferred tax. So if something happened and you had to sell all your assets in 2003, you would have paid about $200,000 in tax. If you go forward and look at that over time, it's been growing. And then about 2012, remember, high income year, all those kind of leveled off and got large and leveled off. And then current really ramped up in 2020 because of higher prices. But also we see intermediate and long-term increased also during that period of time. And so we'll see that we went all the way up to about $1 million of deferred tax. So we think about that, and that's about 400,000 current, 300,000 intermediate, and 300,000 of long-term. Most farmers out there aren't going to recognize all of that. The long-term is the land primarily. That's just going to, you're going to pass on to the next generation or other heirs. So you probably won't recognize that full tax liability there, but your intermediate would be your machinery sales and selling off your equipment. So just be aware, especially if you're getting close to retirement, this is something to start thinking about, but also make sure you're aware of that. If something happens on the farm, you have some liabilities out there you need to think about, and they're not typically on our balance sheet. We have a place that we can put this on our FBFM balance sheets, and we typically only have maybe one or two that really put that in and do that. But we've started showing this slide to our clients over the last probably 5 to 10 years as a discussion point. And especially the ones that are getting close to retirement, if they haven't seen this is a kind of an eye opener of, hey, we know we're going to have to sell our current assets and some machinery in the intermediate. So, even that's $700,000 of deferred tax there. I want to go back and clarify on that last slide, the tax number that was talked about. That's not only just income tax, but also self-employment tax as well. So it's all the tax that you'd be paying on your tax return primarily, or would it be paid off your W-2 withholdings? All right, with that, we got all of the information we want to cover, all the things covered. What we want to know now is what do you want to see on future webinars? So Jim, if you would pull up that poll. So from the last webinar that we had some feedback, and here's some things that they would like to see. So now we're going to reach out and see what you guys think about these topics and see what you think. We've got risk management. That's a wide topic. You can be talking about crop insurance. You can talk about insurance on the farms. You got farmland price trends and projections. That's a very good one. We just talked about, you saw what farmland's been doing there and the projections we have. Marketing tips. Definitely going to be looking at break evens and figuring out where those are compared to when you should be selling. Joe Jansen's done some good work on some of that pieces of, when farmers are marketing in Illinois. So this might help see some of those pieces. Finance perspective. We kind of give that a little bit from two different angles, right, Gerald?
Yep.
But we can also look at that and say, hey, with these economies, where do we think that might be coming? And then sizing equipment for my operation. We've touched on that a little bit in our October webinars a little bit, but maybe dig in that a little bit more. And what is some projections, some average that we're seeing out there on some of those sizing of those equipments for those operations. While you're finishing up that poll, Gerald, do you have anything there you want to mention on those different topics?
Yeah, I think with these topics, it's actually pretty fascinating. We get an idea of what you would like to hear from us, and we're really curious to know what our next topics are to provide to you. So please submit your opinions. We'd like to hear it.
Yeah, and if there's others that aren't on the list, please put it in your survey at the end. That's good feedback for us. And like Todd said at the beginning, we try to get those back really quick, and we start analyzing and looking at them. The ones from the webinar from last week, and Gerald and I are already keyed up on those last two topics to know kind of some information about that. So, absolutely. So it looks like, which I kind of thought this might happen. Marketing tips is 52%. I guess we're looking for everybody to tell us exactly when to sell and where the high and where the lows are, right, Gerald?
Yeah. Looks like it.
But all the other ones about the same, about 10 to 15% on those. So you guys can all see those as well. So thank you for being part of that. That'll help us out. All right. So upcoming 2024 IFES webinar. So to follow up to other presenters that I have on there. So February 1st, that will be Joanna Kalusti, South America's crop production and the El Nino influence. And then we'll have the grain marketing outlook. So we'll see how that goes on some of the marketing advice piece. We'll see how that comes up on February the 8th at 2 p.m. Notice that's because there's a crop report on that day. So they want to make sure they bring in, have more current information for you. February 15th, farm policy, current state, and a look ahead at farm bill and those type of things. I know Jonathan said, I don't have a lot of new things to talk about. So maybe there'll be some new things to talk about. He had some different timelines that'll be interesting to see there. And then February 22nd with Scott Irwin, the renewable diesel boom. What does the future look like? In the presentation we had, he usually talked about, well, you all saw that Nick's presentation on the farm budgets. What are those going to be? So Scott had some interesting pieces in his as well. Also wanted to bring your attention to a new webinar series that we have going on, Cultivating Caution, a monthly guide for farm safety and health. I think we were supposed to have one of these last week, but Jim made a comment, a little bit of ice, we probably shouldn't be doing it. So we didn't have that webinar. So we'll be having those coming up as well. So pay attention, go to the link down at the bottom and you go in and register if you haven't yet. Also want to take time to identify and recognize our Farm Doc sponsors, TIIA, Center for Farmland Research, Compeer Financial, Corteva Agroscience, Farm Credit Illinois, Illinois Corn Association, FS Growmark, and Illinois Soybean Association. Also want to think about our Farm Doc educational partners, the College of Agriculture and Consumer Environmental Sciences here at the University of Illinois Urbana-Champaign, the Department of Agriculture and Consumer Economics, and Illinois FBFM as well. With that, we'll have thank you. We'll see if there's any questions for us to answer, and we'll give you a moment to get those entered in here real quick. Gerald, as we're waiting for some questions to pop in, do you got anything to add to what we've kind of talked about? Any of my slides you want to go back and hit on?
Yeah, I think the most interesting thing about this morning's GDP announcement is really what it means for interest rates and the cuts that were expected this year. It appears as that maybe March might not necessarily be the first rate cut. We may actually see it later in the year. But again, as we mentioned earlier in the presentation, a lot can happen until the end. So keep your eyes out on any information pertaining to how the economy is doing and more broadly, the global economy as well.
Thanks, Gerald. And I'll go back to my question I kind of mentioned there before, is that on the tax, the family living slide, that is not only the income tax you'd pay, but also the social self-employment tax you're going to be paying as a farmer. So all those pieces of tax there. So some of that's farm and non-farm pieces as well. So as you have other questions, please put those in there. So some interesting pieces that are coming out. We're seeing, like I said, on the farm side, is the inventory change has been a big piece that we're seeing on these 2023 incomes that are coming up. I'm really looking forward, because my job at Illinois FBFM is a VP of data analysis. I get to open up all these records once they get submitted by our staff. And March 1 is my Christmas. So I get to see where those are at. So it'll be interesting to see where these farm incomes are. But hearing those initial things out, there's big swings in there. We got some a lot of farms hit by derechos and some windstorms and other things, dealing with some how to replace those assets over on the western side of the state. So it's interesting to see those pieces as well. All right. Well, I think once again, we appreciate your time here. And we got another question just popped in there. So as we're getting ready here, make sure you take a look at these, go back to where these are archived at. You can always go back in and see them as well. So question is, how's income averaging using cash basis been compared to accrual basis for net taxes paid? That's a great question. We've not really looked at what the accrual tax number would be on the standpoint of that. I mean, you kind of see that from if you looked at the piece when we just showed the deferred tax piece of that, but income averaging on cash basis compared, I mean, my number is just strictly showing what the number is going to be in most tax software. And what we do here is we try to optimize income averaging. So income averaging using cash basis has been helping a lot. But when they change those brackets, a lot of farmers have had some high incomes, and really it doesn't help too much unless they had a year back there. So a lot of income management can help with that. So that's a good question. It's hard to answer. That might be something we can look at a little bit more and compare with that deferred tax liability slide I have in there, because we'd have to go and look at, if we were paying the tax off the accrual number that we have, where that's going to be. That's a great question. All right. Well, with that, we will put that in our queue so we can make sure we think about that on some upcoming, maybe Farm Doc articles even. But with that, I'd really appreciate you all for joining us. And once again, go to the Farm Doc Daily site. These will be archived there. And also don't forget to visit Illinois College of Agriculture, Consumer and Economic Sciences website and take a look at this on YouTube. Thank you very much.